probably 2 years away from completely doing data-driven investing. We just launched one of the first ever publicly registered funds. I think we did 1 5-minute call and invested in, I think it was 48 hours post-application. We have 148 companies in our portfolio. We have a completely open, data-driven approach to evaluate and get companies. Wendel is our AI analyst. So we've been working on Wendel for probably 6 years. It gives every company like a Morningstar type rating, 1 through 5 stars, and we only look at 5-star deals. But the hardest part about a sort of data-driven approach is the feedback loops. How do you get enough outcome data to refine your model? Going from zero revenue to greater than 8 or 9 million in less than a year. And most of my algorithms are around really intricate daily indicators. We'd love to write $1 million pre-seed seed checks automatically or within a week. 4 years ago, getting on like a Zoom with a founder. At the time he was 15. Over a given year I do millions of trades.
Today we get to speak to Chris Hjelm. He's a general partner at Connetic Ventures, which is a global leader in venture capital when it comes to data-driven investing. Before Kinetic, Chris was a co-founder at Mint Capital, which is a high-frequency trading fund. It's a great episode where we learn what it takes to build a leading venture capital fund based on data. Let's get stuck in. Chris, thank you so much for joining us here on season 1 of the OpenVC Podcast. It's an absolute delight to have you on.
Thanks for having me, Harrison.
I want to get straight into data, because data has been such a big part of your career, starting at dunnhumby, going into Mint Capital, doing high-frequency trading. What first got you interested in data?
I took the ACT for college and I got perfect scores on math and science, and then English reading, I think I got like one of the lowest scores in my class. But really, when I was in college, I just was kind of lucky, so I got an internship at dunnhumby. They were Kroger's data analytics arm, so Kroger's a big grocery retailer in the US. dunnhumby, I was employee number 25 or 30, and then when I graduated college, they had 800, 900 employees and grew to, I think, 3,000 or 4,000. So it was really just like I was in Cincinnati for a job, and it was, not known at the time, but kind of just fell into a really cool both culture and data-driven company.
Awesome. Okay, so what kind of things were they innovating on back in the time that you were working there?
Yeah, so Kroger was probably the first retailer in the US to have a loyalty card. So it's called the Kroger Plus card. Tesco pioneered that in the UK, and so they kind of copied that model. But really no one in the US had loyalty cards to scan at any retail location. dunnhumby was using loyalty card data to perform analytics. How are new products performing? What prices should products be? What should the assortment be in store? So they hired dunnhumby, which is a UK-based firm, and partnered with them and essentially spun up their own office in the US.
You get a fantastic foundation at dunnhumby, and then you move from retail into high-frequency trading at Mint Capital Group. Can you tell us about the transition?
It was different. I had been there, I think, for 6 or 7 years, if you account my internship, and was ready for something different. My major in college was finance, and so I was trading on the side and always interested in markets in general. I had a lot of friends in Chicago that were into high-frequency trading, companies like Jump Capital. Obviously, there's a big commodities trading community there too. I've always had an entrepreneurial spirit as well, and wanted to do something on my own and different.
Awesome. Can you tell us about anything unique that you were doing with your high-frequency algorithms?
Over a given year, I do millions of trades. So it was very intense, like consuming. It was almost always on very kind of risky NASDAQ, lower flow. So it was things that had a ton of volatility. So I was building most of my algorithms around really intricate kind of daily indicators.
It was a good stepping stone because you then went on to launch Kinetic, which is an entirely data-driven led VC fund. And you were completely off to the races with your first fund, having $25 million to start with. Can you tell us about the thesis behind Kinetic?
And my friend and coworker at dunnhumby actually started Kinetic a couple of years before I joined. And so I started renting office space from them. I actually rented the office I'm in now about 8-9 years ago. And I just found myself, when the day wrapped up, I usually trade until like 2 or 3, and I would just sit in on pitch competitions or just pitch meetings they had around the office, and just became fascinated. Cincinnati 8-9 years ago, startups, venture capital was not a thing, and so I think we were probably the first actual venture fund in the area to start. It just felt kind of sexy and just mysterious. I started working part-time, and it kind of pivoted when we went down the data-driven approach to a full-time.
So how did that happen? Did you convince them that they needed a data lead? Or did they seek you out after they saw what you could do?
I remember we had 2 local startups come in, and we heard their pitch, and it was very painful. And just like, it's one of those where you're 5 minutes in and you're just, it's not going to go anywhere, but they're in the office and you want to be nice. They're just like, I can't keep doing that. And so we drank some bourbon and whiteboarded. And all 3 of us realized, A, there aren't enough local startups to make a fund work in a non-tech hub. And so we realized, A, not enough talent here. B, we don't have any money or brand, and so there's no way for us to like travel and source top deals, but there probably is a way if we have a completely open, data-driven approach to evaluate and get companies that we wouldn't be able to in a hands-to-hands type like meeting.
Amazing. So this is back in 2018. There weren't many VC funds tapping into data the way you were. And that was coming from the pain point of an investor suffering through bad pitch decks sessions. The fund had already been raised before you had this data-driven approach. So there was a bit of a change.
Kind of, right? Even with like startup announcements, funds it's probably 70% truth and 30% like some other things happen. They had been investing, operating for a couple of years prior to us raising the $25 million fund. It had already been around for a little bit.
And when you went to raise that fund, were you using the data-driven approach to excite LPs, or was it scaring LPs, or did you just not talk about it at all?
It was like in our minds, venture is an exciting asset class. You don't have any other opportunities to get into venture because there really aren't any other funds. So it was really just a pure, hey, everyone should be in venture to some degree, and so we had to get them excited about the asset class. I don't know if we even talked about any sort of data-driven approach at that time. I don't think so.
Okay, no, that makes great sense. So you touched on Wendel just a bit earlier. What is Wendel?
So Wendel is our AI analyst. So we've been working on Wendel for probably 6 years. It took us about a year to kind of build our MVP, and we went through a ton of iterations of what should we collect, what should we analyze. For some context, that's probably important. We're a very early stage VC, so think pre-seed, seed, a couple of founders with an idea, some early traction. And so what you can analyze is almost zero. I think when you start to get to Series A, Series B, there's likely some applications of revenue models, website traffic, maybe some accounting integrations to evaluate, CAC and capital efficiency. But one day we were like, we've got people, you've got an idea, what can you analyze in those 2 aspects? And
yeah,
we probably spent 6 months researching industrial psychology and personality assessments, and found one really liked, and we had partnered with a local professor that specialized in those type of assessments, and we got to build our own from the ground up with him to analyze everything that's ever been published, ever been in literature around what makes entrepreneurs successful.
Okay. Wow. So you've got this immense capability to assess people. One of the biggest advantages that you're public about is how Wendel increases the inclusivity and removes some bias that humans are subject to. Could you tell us a little bit about how you can rely on these tests because the data supports it when historically minorities have been underfunded, underrepresented, and might not have the same amount of data as the traditional white male?
Yeah. So I think definitely the biggest part is we're not evaluating background, experience, and I don't think there's one right way. But MIT had built an algorithm trying to predict startup success, and it literally just looks at a LinkedIn page and factors in university, degree, and experience. Which, okay, well, if you do that, that's just going to be the traditional venture model of let's back Harvard graduates that are 3-time founders, which ultimately would probably be white male. And so we purposely didn't want to include anything, nor did we think that was relevant or would allow us to see deals or capture deals that aren't already being funded. And so literally, since we realized that, everything we've done, every assessment we have on our platform, obviously we've continued to build out what we analyze in our internal IP, but we validate everything for fairness and accuracy and fairness across race, age, and gender. So all the things that if a startup completes through Wendel, those have actually been, academically validated for fairness across the common demographic.
Okay. And does that change like the weighting in the points-based system, ultimately to give you an indicator on whether they're investable?
No, none of that. So a lot of our kind of core assessment is a traditional personality assessment. It's called an activity vector analysis. It's like a DISC Enneagram type. And for that, we just measure, if we're going to show you these words, we want to make sure people say yes or no, like that describes me or not. The same across, if you're a 60-year-old white man versus a 24-year-old. Once you complete the process, it gives every company like a Morningstar type rating, 1 through 5 stars. And we only look at kind of 5-star deals that Wendel likes.
Amazing. Okay, so if I'm a founder, I'm interested, I want to get self-assessed, I'm signing up to Wendel, I do a personality test. How long does that take me?
So we have the application itself, so talking with Wendel is a 5-step process. 2 of those are assessments, and the total application takes about 20 minutes. We built with intention to make it as quick and hopefully painless as possible, but also fun. And so, even if you complete it, you get some PDF downloads of who you are as a person. We're building in some, feedback recommendations around yourself, people you would likely work better with. The biggest thing, we want to build feedback for startups that spend time with us to make sure, even if it's a no from us, they're getting some sort of helpful response.
Amazing. And do they get benchmarked against everyone that's used it before?
We've talked about that a little bit on one of the assessments, but there isn't an overall, here's where you scored. Obviously, we'd like to be as transparent as possible, but no, that's not always received well.
Okay, fair enough. So in the building out, in the optimizing of Wendel, have there been any interesting moments where you've uncovered blind spots that you didn't imagine to be in place?
That's a good question. I don't think we know yet. Right? So the hardest part about venture, specifically trying to do any sort of data-driven approach, is the feedback loops. We're looking at 12 to 16 years likely until an exit. And so the hardest part about doing this in venture at all is how do you get enough feedback, outcome data to refine your model and feel confident in it? Like day trading, right? You can backtest. You can't backtest anything in this space. And so the first 3 years we were kind of flying blind. We're like, all right, this is what feels good. I think these people will likely do well.
Being too humble, you've published Wendel's success rate and how it's much better than a human analyst.
Well, that also fluctuates with outcomes. And so really 5 years into it, so this was last summer, that was the first time I think we've had sufficient outcome data. So we have about 18,000 companies that have applied through Wendel over the last 5 years. And now we have outcomes on 3,200 of them. And so for the venture space, that's incredible. For data analytics and machine learning, that's the tiniest sample size possible. But we feel pretty good now, and it only compounds over time. So I'd say we're probably 2 years away from completely doing data-driven investing, maybe not even having a human. But currently we use it as a filtering tool. 5-star opportunities I'll meet with, or one of the other 2 team members, and we'll just make sure, all right, is this business for us? Do we believe it's venture backable? Can it scale? But we hope to in 2 years.
I'm sorry to cut you off, but if a founder does well in the test, they immediately get a meeting with one of the partners.
Yeah.
Before you even know the sector of the deck.
Yeah.
Awesome. Okay. And what kind of percentage of founders actually get a 5-star rating?
It's 8%, and we can toggle that. So,
pretty high.
Yeah. And of the 8%, 25% end up getting a check from us.
Wow.
So if you compare that to the average venture fund, I think it's 0.02% of people that inbound to a venture fund get funding. And so if Wendel says yes, by the time you spend your time with a human, your likelihood is 100, 500x greater than any other fund.
Okay. Wow. Wendel, is that a score you get as a founder that you could share beyond, or is this simply a tool that Connect uses?
Good question. We've onboarded a couple other VCs that are friends or believe in a similar thesis. We can share them within Wendel. Deals can close in a week versus months. If someone completes Connetic Ventures application, they'll be prompted with 2 to 3 other funds that fit the sector, stage kind of criteria. But we're still trying to figure it out. It's hard to run a startup while you're running something else. I think all founders can relate to that, right? Like there's always a passion project.
Has there ever been a time where Wendell has revealed something that if you didn't know through Wendell, you probably would have invested?
Yes, we do. It's always been iterating. That like gets to something we released last year is we actually measure the likelihood of someone being honest throughout the application process. And so we have like a green, red flag on account applications. About 9% of applications are invalid based on our data. And the other interesting thing that we've built in is we measure levels of dark triad or narcissism. So there's like Machiavellianism, narcissism. And so we know like the level of toxicity, but that's what we call it internally, of someone. And they're not necessarily a bad thing, but there is a point at which it is a bad thing. And actually a couple people, I think one in our database, we did invest because of that. They committed fraud within their company and are out. So not that that's like an end all be all, but between those two things, those are some interesting things I don't think you'd ever pick up on traditional diligence that maybe we don't give it like full weighting, but it's good to know and kind of pry if we do have concerns.
Awesome. Okay. So Kinetic, you're extremely data-driven. Founders get a meeting as soon as they've hit 5-star ratings after taking a 20-minute assessment. But for a data-driven VC, you also create the time and space for human review and the human element of investing. So what room is left for a human in the evaluation process?
Great question. I think that if you ask, there's 3 partners that do deals. Each one of us would have a completely different opinion on that question. I do think there's probably an element to evaluating the business, thinking about macro trends, thinking about exit, like doing the traditional like venture diligence, whether it's in your mind or like having an analyst do it. We don't go that level. And I know I said 2 years, we'd love to do completely automated investing, no human involved. You complete it, we can even like auto issue a term sheet, wire the money that day. It's just like a healthy debate internally, so I don't think there's like a good answer to that.
So once a founder's got a 5-star rating, they're going into a meeting with a partner to assess their business. Do you actually care about the sectors in the business plan? Because I know some funds, they just make a decision based on founders. And I remember reading that Wendell can assess the probability of success a founder will have 2 to 3 times better than industry average. So you've got this heavy weighting that this founder's going to be impressive, but they can't always sync up with having a really impressive idea in a really impressive space.
Yeah. I think there's 2 comments on that. First being, for us, industry, like there's some that we don't do, it's like very few, but like med device, biotech, deep tech, something that's super capital intensive, just because we're primarily doing deals like outside of San Fran and Boston. And so the likelihoods of them raising hundreds of millions and like building something that complex are low. And then it just becomes a pricing discussion. If it's a consumer product company, we don't do much of that, but we're not going to pay the same price as a AI SaaS company. And so we think about sectors more as like prices you pay. We've got like lots of internal documents around what that should be, and Wendell tells us what it should be as well. And then kind of like your other comment on people and pivoting, it's a good comment, because if you look at, we have 148 companies in our portfolio. The top 5 in terms of weighting of our portfolio, the most successful, all have completely different products than what we invested in. And so it's like, when you're doing our stage, how much, like what is the appropriate level of diligence? Because you're not, like this isn't the end product. This might not even be the same industry. And so that's why we always could gravitate back towards people and like, all right, why not give exceptional people a shot? Because you never know. And so for us, it's like panned out over 5 years. Yeah, top 5 companies, completely different product. Generally the same industry, but wildly different.
Can we pick into that? Could you share an example, maybe the most extreme?
Well, like a fun example, It's a company called Colorcast. They're an Austin-based company. They started as a live sports and broadcasting. I think the Manning cast, if anyone watches Monday Night Football. But essentially you can tune in your favorite soccer, football game, pull up their app and log into any of these like we're doing now. So you can listen to Chris and Harrison call, a Chelsea game. And so it's like a social curated broadcaster network. Like crazy engagement, downloads. It was like exceptional, like amazing how many people are using it, but there's no way to monetize it. Like they just couldn't crack that. I remember talking to the founder and he literally shut that business down after working on it for 5 years and launched a sports betting analytics app. That it's like all these tiers, and they grew from they went from zero revenue to greater than 8 or 9 million in less than a year. And so like that's the most extreme. I've never seen anyone. Usually someone like pivots their core platform or leverages the tech in some degree, but I've never seen anyone after working on something that long to completely scrap it, like throw it in the trash and start something new. So that was one that was, it's both, they're still in sports. It's not even remotely close to the tech stack and like everything you would need.
Because it was live streaming versus gaming, were they even able to use the consumers that they had before, or did they have to start from scratch with that as well and on board?
Start from scratch completely.
Okay, amazing.
It was cool.
Amazing story. Going back to Wendel then, I think just the last comment. What are you most proud of in terms of its impact on Wendell's ability to help you make investments?
The thing that makes me happiest in my kind of day-to-day job is every call I have with the founder. I'd say it's 98%. We're like overwhelmingly positive. Of like, we got on a call and they're like, just like before we start, that was the coolest process I've ever completed. Thank you. I probably sent 800 emails to inboxes, gotten 2 returns, and like regardless of this goes anywhere, I just want to thank you for trying something different because this industry is beyond frustrating. Yeah, I think they relate because they're founders too, right? They're trying a similar thing of disrupting an industry, making customers happy. So that's probably day to day my proudest moment.
Awesome. Okay. Thank you. Could you share an example of where the data was so convincing that you just instantly wanted to invest? Is that every 5-star that comes? Or is there like a super score of we need to speak to these guys yesterday?
There's a super score. We've actually only had 2 deals that ever hit every. One we did 1 5-minute call and invested in, I think it was 48 hours post application. And the other one, I can't recall. I actually don't think we ended up doing it for whatever reason. But yeah, so that was, they're doing very well. They just raised, we did pre-seed, pre-revenue. They just raised, I think it was an $8 million Series A. And so hopefully it's like, all right, well, hopefully that trend continues where we'll have a small subset every year where we don't even need to do human diligence and we're just good to go.
What happened on the 5-minute call? Is it you hanging up? I've heard enough. I don't need to hear any more. Is it the founder saying, sorry, I've got to go? Surely you could get half an hour.
Yeah, it was weird. He was like, that's cool. I'm like, I love the business. He scored just extremely well. And I think it was like there's some time pressure on it too. He was like,
okay,
we're closing around for the next 2 weeks. We've got $250K left. And I was like, we'll take it. And so it was, yeah. He was at a conference too, so it was like running between meetings. So it was like kind of awesome. A forced short call.
No, there are 2 schools of thought. One is very confident that data is going to replace humans in the VC space, and there's going to be enough data assessing on founders to have enough conviction to actually give people money without ever meeting them. And the other is a bit more skeptical and thinking that, well, data can be manipulated, data can be a bit unreliable at times, can have blind spots that we're not aware of. So we're always going to need a human in the process somewhere. Where do you stand on those 2 theories?
When we started 6 years ago, I thought there'd be some VCs doing something. Like fast forward to now, I haven't seen anything. I think there are just too many. I actually think like later stage investing, they're not really doing diligence. They're just throwing money at hot deals. So I don't think there's actually time to have some sort of data-driven process and later stage VC.
Relying on data, so you should be able to have a higher confidence level in the best deals if you brought a data-led approach to those opportunities.
Yeah. I just think those opportunities are so competitive that I just don't think it gives you an edge there. Like it has to be in a non-competitive space. And I don't think, at least we've seen people going away from early stage VC and
The management fees. Everyone wants a bigger fund, right?
I agree. Yeah, so I'd say 10 years, maybe 25% of VCs use it for some sort of diligence, maybe 100% use it for sourcing. But no, I don't. I think there's too much, and this is like not to be mean, but too much ego. When you think about the people that run or start venture capital funds, or either highly successful entrepreneurs that have confidence that they know how to evaluate those business or like help operate and be on the cap table, they would never take a data-driven recommendation on investment. And then you've got like kind of emerging funds that are looking for a differentiation, but the feedback loops to get anything meaningful and the cost of it are prohibitive. Like it's tough to run an early stage VC. So I think there might be a handful, but I think less than 25% will use it for some sort of diligence or decision making.
Okay. In terms of follow-on capital, you mentioned that in that startup that had a perfect score, you did their pre-seed and seed round. Do you make founders do the same test, a different test, when they're looking to raise a second round?
We'll collect some new, so we can like re-trigger some things. We do a lot of internal evaluations automatically, and so we'll request some new financials and different things, but we're really good at spotting deals earlier than everyone. We're pre-seed. You know, we used to be a 3-check company, which like thinking about is insane, but we used to like do this pre-seed, seed, and then like want to do more in the Series A. But in practice, like you can't do that. The successful companies end up, you know, there's just no room for you in a Series A or seed round outside of pro rata. And so now we've kind of pivoted as like, all right, do we believe in what we're building? Do we believe we're better and can identify jockeys early in the process? And so we're moving towards let's do a larger initial check and then do pro rata, probably through a Series A. And maybe we want to do a growth stage fund where we lead Series A investments in existing portfolios. And we think that's a nice way to, you know, not require a lot of extra work on our end and still maintain a lean team. But no, there's no set of indicators we know or evaluate to determine.
Okay, very interesting. So with that inability to move up into rounds, the tactic is bigger checks at the same stage and following a pro rata allocation. What does the future look like for Kinetic now? Does it mean more geographies, more capital deployed into more businesses?
More capital, hopefully. 2 months ago, we just launched one of the first ever publicly registered funds. So we actually are registered with the SEC. The two kind of big things with that are it's 1099 tax reporting instead of K1s, and we can take unaccredited investors versus only accredited. And so when you think about democratizing venture capital, we built Wendel, great, any founder with internet connection can apply, but going forward, theoretically anyone can invest in our fund. And we did that for a number of reasons. That's kind of, we think that's where the industry is going, and we think there's a lot more capital for us there. So yeah, our future, we'd love to write $1 million pre-seed seed checks automatically or within a week. We just know that's the biggest pain point for startups is they spend 12 to 18 months cobbling together angel checks and some small funds, and everyone's in, but they want to lead. And so like no one's taking the pre-seed seed lead. Like you have YC, you have Techstars and some other smaller players. But for the founders that don't want to go through a boot camp or don't get in, there's really no easy pre-seed option for them to just build their business. And so we think if we just write $1 million pre-seed check to super early stage companies, that's the only glaring hole I've found in venture, and I think presents just incredible.
Wow. Okay, that's really exciting and a huge opportunity. So the first is unsophisticated investors getting access into VC. I'm a bit nervous about that because I think the unsophisticated investor sometimes doesn't understand the risk profile of venture capital and the liquidity troubles that come with it. So there is some educating to do to make sure it's the right fit for the unsophisticated investor, but ultimately it is a very nice asset class for those that can enter it. Do you have an idea of how much you could take in this new fund from unsophisticated angels? Do you have an idea of what you're trying to raise?
So that was just like a benefit of the fund, but that is definitely not our target group.
Okay.
So our target investor going forward will be financial advisors. So someone managing money on behalf of a large client base that wants to allocate their, let's say aggressive portfolio. Now it's high growth stocks and like no bonds. They currently don't have any venture option they can put in that, have very limited private equity, they have some REITs. But we want to become a small allocation base of a financial model within an institution. So it's not like, I'd say less than a couple percent will be individuals, and more, how do you tap into the registered investment advisor market and make a product that you can click and now you're okay, now 3% allocation to the VC. Just like kind of Bitcoin's doing, right? It's with ETFs and different structures. People want Bitcoin in their portfolio, and people are creating products to allow that at scale. So we're trying to create a product that allows VC at scale.
Amazing. So you could potentially have, madness, but like $1 billion in the fund automatically getting deployed into $1 million checks at pre-seed seed.
Yes.
And it making sense with the most data-driven approach in this space.
Yeah.
Are you charging
Wendell,
a premium for that?
Wendell allows that to scale, right? So it's like, I think this only works if you've got a way to deploy, to your point, deploy at scale. And so we think like we have the chassis now. And so, but that's exactly our vision. It's like, $1 to $2 billion that you can just write $250 million checks a year and do some follow on and maybe raise a growth fund. Fingers crossed.
Nice. Okay, so the future is bright. Is that product live now? So for any financial advisors listening, do they have a minimum investment size? How do we get in touch?
I don't know legally what I'm allowed to say. We just launched this and now I'm like going through compliance, like learning. But you can go to conneticventures.com/VCAFX. That's our ticker. We have our prospectus there, all the information on the fund. You can download like fact sheet. We did the really cool thing, I think. We merged our private fund into that structure. So we started day zero with 100 plus holdings of 5-6 years of investment. So varying scale, varying industries. So it's kind of already a diversified VC holding base.
Amazing. So it's an ETF exposure to pre-seed investments that you've already made, with exposure to the next ones that you're making, with all the learnings that you've already had. And the bigger the fund gets, the more you can write, so the more value you can capture, and that flywheel effect comes into a really nice scenario for you guys.
Couldn't have said it better myself, Harrison. Yes. I keep just like a running list of just kind of crazy stories. I remember there's like lots of vivid first-time calls, right? Because I don't look up founders. We rarely look at a pitch deck. I remember 4 years ago getting on like a Zoom with a founder. At the time, he was 15.
Did you know that before the call?
No, I had no idea. And so I think it was like 7 minutes in. I was like, all right, how old are you? I said no to the business. I said no, and it was like solely because of age. And he ended up acquiring a company. And we ended up investing, I think, a year later. But it was that was like the most vivid memory I'll always have. Is I think I have a huge age bias. We're probably both on both sides, and so that helped me. It's like, all right, it's just been fun. It's like learning, what A, I want to do every fintech deal. B, probably ageist, and so I'm working through that, and I think I've learned.
Wendell's going to get you there. Okay.
Yeah.
Have there been any surprising anti-portfolio companies, ones that maybe didn't score as well as you would have thought, given the success that they've had later?
Yeah, 100%. I think that's just that will happen. So, like, luckily, based on our 3,200 outcomes, one-star companies, I think our data is always changing. I guess we get more companies with fewer outcomes, like the percent win rates kind of vary, but it's a complete linear line from, call it 5% to 30-something percent 5-star companies. And it's linear, and so hopefully it stays that way. But yeah, you'll miss, and that's why it's tough to get feedback, because you don't want to tell someone, it's like, hey, you're not an ideal CEO, CTO, or your team, because anyone can win. It's just like, how do you increase your odds of making a good investment? So yeah, we'll always have lots of losses just by passing. But I think the ones that stick with me longer are the deals that were 5-star that ended up being crazy successful that we said no just for some reason. And a lot of that's like we just historically haven't had much cash. Every given month we're looking at 15 5-star deals. We can only do 3. That's tough.
We need to get you guys some more money. Let's get the stuff
Hey.
deployed. So what was your latest fundraise? What was the funds under management? Because I mentioned the 25 million was the first fund, but you must have raised a few more since.
I think total is close to 50 million, and that's
Okay,
not including anything raised in
fresh.
new structure. And under our office, we obviously have Wendel and some developers. We've acquired or taken over assets of a couple portfolio companies that have gone under. We have five businesses now that we own and operate. So we've got some other stuff going on. I'm strictly on the fund side, so I'm not part of that, but
Yeah.
I think we've got 30 people in the office now that are working on various things.
Okay, so that's a bit unusual. So the startups ran out of runway, they've gone bust, but you still believe in the product, believe in the team, brought them in-house, given them a new lease of life, maybe with new management, maybe not.
Yeah.
What kind of things are attractive? Because VCs have portfolio companies go bust all the time.
If it makes sense based on what we're doing or if the price is right and there's an entrepreneur locally we know. I think that's the cool thing of doing this longer and longer is you have exit founders or founders that have really unique expertise and everyone's always looking for their next thing and they might not necessarily know what that is. We own the debt on it and so we could either decide to take the assets or not. So it's not like we're spending capital in addition to go acquire it, but we like locally, especially locally, we've got entrepreneurs that we really like and have great potential. If we can pair them with something and can ideally make everyone a little money at the end, it's
Okay, cool. Two quick questions then. The ETF product, the new fund, what kind of pricing model do you have for that? Is that the traditional 2 and 20?
no. So legally, you cannot charge a performance fee on a registered product.
Okay.
So we just have a straight management fee of 1.9%. So in terms of total cost for a venture fund, it's unheard of
Yeah.
ever. And it's how much we believe, I think, in ourselves, and that kind of the future is oversight, registered, making. And when we started, it's called an interval fund. It's like a type of mutual fund. I think there were 20 in registration or active. Fast forward to now, I think there are 280. And so the growth of this category is just going to just explode.
Are you aware of other VC funds doing a similar thing, or are you pioneering in this space?
So we're technically not the first. Kathy Wood, Arc Ventures,
Oh,
has an interval fund. It's almost exclusively secondaries and super late stage companies think
okay. I didn't know.
SpaceX,
Is that the
Andro,
FinTech Innovation one, or is that something else?
something. It's the
Anyway,
Arc.
she's got loads of ARC funds.
Yeah,
Yeah.
Arc Innovation Fund, I think is what. Yeah, most that have done this are really just secondary plays and late stage stuff. I don't think there's really an active VC that
Yeah.
has launched
Cool.
one.
Amazing. Well, look, pioneering. I didn't know that was happening. Thank you very much for being open. It's been amazing. Thank you so much for your time.
Yeah, I appreciate it. I love chatting about everything, so I love your questions, I appreciate you taking the time. You go to conneticventures.com, and then that's probably the easiest way, and then there's on the landing page, it says apply for funding.
All right. Well, we need to do this again in a year's time when you have that 1 to 2 billion fund and you're deploying across all of America in the big pre-seed rounds. I'm looking forward to it. So I'll see you there.
I'll be here.
Awesome. Thanks, Chris.
Thanks, Harrison.